Hello and welcome to today's webinar, How to Negotiate with VCs. My name is Jerisa and I'll be your moderator today from the Early Growth team. Before we get started, I wanted to make a few quick notes. One, this webinar will probably last about 30 to 40 minutes. We will include time for Q&A at the end of this webinar. You can feel free to post your questions into the control panel. We'll make sure those questions get answered. The next thing to note is this webinar is being recorded and it will be sent to all registrants with the slide deck within 48 hours, so look out for that. You can also find this recording and all of our recordings on our YouTube channel, Early Growth, so feel free to head over there, subscribe if you like, and listen to this webinar again and some other ones. So now before I pass over to our speakers, just want to tell you a little bit about Early Growth. This is a quote from our founder and CEO, David Ehrenberg, and at the top you'll see just a few of the companies that we have worked with in the past or currently working with. If you have not heard about Early Growth, feel free to go to our website, earlygrowthfinancialservices.com. We are an outsourced financial service firm. We offer accounting, CFO consulting, taxes, and valuations. So head over there, get a free consultation if you like. And now I'm gonna pass this over to our speakers for today.
Great. Well, thanks, Teresa, and to the rest of the Early Growth team. And thanks for everyone for joining today. We're looking forward to sharing some insights with you all. We'll run through the presentation pretty quickly, and then leave some time for Q&A. So first, a little bit about us. I'm Nick Scannavino. I'm here with Zach Levin. We are the co-founders of a tech startup called Pitchtape. We previously founded a boutique law firm in New York City, focused on working with startups and investors, mainly with respect to fundraising rounds. And prior to that, we were corporate attorneys at a large international firm based in New York City. So I'll tell you a little bit about Pitchtape. After many years of working with startups and investors, we kept seeing the struggle in the early stages of the fundraising process, so especially founders struggling to create a compelling pitch, stand out from the crowd, get connected to the right investors. We sort of felt that the prevailing methods for pitching investors, like pitch decks and one-pager executive summaries, just weren't doing a good job of conveying the quality of the team, which is really the most important element of a pitch, right? So what better way to showcase the team at scale than with video? And so at Pitchtape, we're building a product that we envision will shift the current static pitch materials to a more dynamic video-based experience and really become the next generation of the startup pitch. So you can learn more about Pitchtape at pitchtape.com. And I'll turn it over to Zach to run through an agenda for the rest of the webinar before we dive into the topics.
Thanks, Nick. Thanks, Nick. That's awesome. And thank you again to the Early Growth team. We're going to start by giving you a broad overview of the state of the startup fundraising landscape and the initial preparation necessary before you begin the fundraising process. We'll then explore the most common funding sources for growth companies and dive into what motivates these entities and how they are positioned in the market. Next, and if an investor actually agrees to back you and put money into your company, you need to understand how that investment will be structured and specifically what % of your company you are selling and the rights of the investor will have going forward. Once we cover these foundational building blocks, we can then dive into the more specific mechanics of negotiating with investors. Everything we discussed today is meant to culminate in this last topic because negotiating with investors requires not just understanding your own company, but understanding who they are and understanding, what you're negotiating over. So with that, let's move on to our first topic.
Great. So let's jump into preparing for funding. So if we step back and look at the venture landscape, you can really see that fundraising is hard, right? And tends to be one of the biggest challenges faced by early stage entrepreneurs when starting and scaling their startups. And while there's more funding available from more investors than ever, there's also more competition among startups for less deals. And we could put some data around that. So we included a chart here. Top left, we show total US VC funding, which went from about 70 billion in 2014 all the way up to over 130 billion in 2018, which was a record year. To the right of that, we show the number of micro VC funds, meaning funds that generally invest in the pre-seed or seed stages as the first institutional check. And that went from about 150 in 2014 up to 650 in 2018. To the bottom left, we could see startup activity has grown as well. So about 13,000 startups applied to Y Combinator Startup School in 2017. And that grew to 27,000 in 2018. And this year, they actually surpassed 30,000. And finally, on the bottom right, we show the number of US venture capital deals actually decreased from around 10,500 in 2014 to 9,500 in 2018. And so again, more funding, more investors, more startups, but less deals. So there are a lot of takeaways there, but the main point we'll make is that founders need to prepare for success. And so on the next slide, we offer 3 ways of doing that, and we'll call it the 3 M's to money. You need to master the funding game, make a big impression, and meet more investors. And so first, mastering the funding game. So you really got to do your homework on your business. Seek to know every detail that you can so that you adequately answer every question thrown at you by investors. You should also do homework on investors. Understand who is a good fit, what they're looking for. Understand the fundraising process as a whole. How long is it going to take? What key steps do you have to navigate through as you fundraise? Preparing the right pitch materials, practicing your pitch over and over again. You often only have one shot on goal with an investor, so you really got to make the most of it. And then also know what you're seeking to accomplish with the fundraise. So for example, know that you want to raise X amount of money from X type of investor to achieve X milestones. So overall, the more that you understand the process, the better you'll be able to navigate your way through it. Second, making a big impression. So it's not uncommon to hear that investors get pitched by hundreds or thousands of startups each year, and they usually only invest in a handful of them. So as best as you can, you really need to make a big impression, stand out from the crowd, and that can be daunting. So we often advise founders to take it one step at a time, break it down into goals. So the goal of the initial pitch is to get to the first meeting. And then the goal of the first meeting is to get to the second meeting. And then eventually you keep working your way through the process to an investment. And then each step along the way, just think about trying to do your best to make that big impression, create a compelling pitch, convey why you're the best team to invest in, show that you really understand your business, your market, be prepared to answer every question from an investor. And hopefully by the end of it, you'll land that investment. And lastly here, meet more investors. So you can view fundraising much like sales. So identify quality leads and pitch to as many of them with targeted messages as possible. And the way it usually works with startup fundraising is that you have to pitch a lot of investors in order to find a few who will invest. And there's story after story about startups hearing no from lots of investors before they ultimately got to a yes. So, keep at it, learn from feedback along the way, and get your pitch in front of as many investors as you can.
Great. So now let's move on to topic number 2, identifying capital sources. So let's be real for a second and recognize that for most startup founders, capital source is your own wallet and your personal savings. And that's a tough road, but it's the reality. But there are outside capital sources available to founders at all stages of their journey and their company's timeline. So this is an overview of the most common outside funding sources for growth companies. Which source is right for you often depends on your company, your product, and your expected users. If your company has a social good or cause, maybe government grants is the best path forward. If you're a consumer good, like a clothing or beverage, perhaps equity crowdfunding or Kickstarter. Going back to what Nick pointed out earlier, whichever funding path you choose, the competition for those dollars is really fierce. And you need to do whatever you can to understand the industry and the various dynamics at play. And for that reason, for any of these funding sources, we can spend an hour alone today discussing the merits of them. But we can't do that. So we just want to put them on your radar. And for our purposes today, we're going to focus on 4. We're going to look at angel investors. Let's back up one sec. Angel investors, venture capital, family offices, and strategic investors. And I just want to do a couple high-level points of caution. First, after you're sort of gone through your own savings, you're probably going to look to friends and family. And we just want to make sure that if you're doing that, you're properly documenting their investment in your company. You should have an entity formed, you should have a business bank account, and you should probably utilize one of the funding structures we'll discuss in the next segment. And the second note of caution, a funding topic we didn't include, which is private debt. And whether that's through a bank loan, like an SBA loan, or leveraging lines of credit like a credit card. Early stage companies, they don't have a lot of assets. So getting these lines of debt typically was going to require a personal guarantee. So even though you're raising this money to spend it on your business, if your business fails, this debt can follow you personally. So starting a business is a risky proposition, and ultimately you will decide your appetite for risk, but we just want to make sure you're going in with your eyes open and understanding the level of risk you're taking. All right, so let's go to the next slide and we'll jump in and dive in a little bit deeper here. Okay, so again, we're going to dive into 4 specific sources of funds: angels, VCs, strategics, and family offices. We're going to try to better understand their processes, all with the view that it will better prepare you to negotiate, against these groups. So what is an angel investor? I think this is a term you hear a lot in the market. Technically speaking, an angel investor is just any wealthy individual. They're typically investing in your business with their personal savings, their own money. And the key here is that since it's their money, they're the final decision maker. You contrast this against a VC or a corporate investor. They have to report to boards and executive committees. So in this way, an angel investor can have a very high risk tolerance. Your startup probably rests on a principle that some product is missing from the economy that should exist, or you have some unique worldview about the way a market should operate. And so even though the hurdles in front of you may be monumental, this angel is willing to take that ride with you. And so because their internal barriers are low, you can often look to an angel to be, sort of the first outside money in your company, in your first check, because they share that common worldview. Another note about, what we call angel investors is that they have a high variance in sophistication depending on what angel you're talking to. So a lot of angels that you'll see in the market have exited startups before. And so they could be very familiar with, a tech startup. They're familiar with the business model, the metrics, the relevant KPIs. They'll be able to talk about customer acquisition channels and tech stacks. Other angels maybe are not that familiar with your product specifically, but they're experts in your industry. So for example, if your product is the next generation app for real estate investing, it's possible your angel knows nothing about building an app, but they actually are owners in multiple real estate projects. Right? So the key is that whatever your angel's skill set are, a great relationship with your angel will have you recognizing and leveraging their core skill set and background to your company's advantage. Next, let's talk about venture capital. So what exactly is a VC? A venture capital institution or firm is an institution that raises capital itself from what are known as LPs, or limited partners. So limited partners themselves, again, are probably wealthy individuals or other institutions. The general partners of the VC then invest this money on behalf of the LPs. Okay, so this pooling of capital is great because they can write very large checks. These large checks can allow your business to expand rapidly. That's hiring marketing teams, sales teams, hiring more developers, opening new offices, launching new product features. But you have to understand that this bifurcated model where you have GPs on behalf of LPs creates institutional structures that will be relevant to how you go about pitching and working with these VCs. So these VCs are going to need to justify whatever investment they make. They need to, put together sophisticated reports to their LPs. And maybe that means going through an internal investment committee, which means that they internally need to check off boxes, right? So what does it mean to check off boxes? It means they need to take certain steps to de-risk their investment in whatever startup they're talking to. So what does it mean when we say de-risk an investment? That means maybe they need to make sure that whoever they invest in has deep industry expertise in a highly technical field. It might mean that as a startup, you need to show serious customer traction with your product measured by total users or total revenue. Maybe those checkboxes mean that you need to be operating in a large enough market that your product has the potential to drive huge revenue in the future. And again, because these are sophisticated organizations, they might be running their own calculations of what it means to be operating in a large market. So you may think that you're operating in a large market and that your user base, creates $1 billion opportunity, but the internal spreadsheets of this VC could say otherwise. And that's a very difficult hurdle for you to overcome. Then that last point we'll make on VCs, and again, this goes to, understanding who you're talking to, is that we're seeing, increased fragmentation and diversity in what constitutes a VC. So we're seeing, you still have your traditional large VCs, but we're also seeing micro VCs where maybe they're only raising 30 million and they're only writing checks for about 250,000. We're also seeing a lot of verticality in VCs, which means that they stick to very specific topics. We've worked with some VCs that only invest in medical products for ophthalmology, right? So VCs can get very, very specific in sort of what industries they participate in. And it's really important that you understand and look into these companies before you spend time pitching them and going, deep into your conversations with them. Okay, next is strategic investors. So strategic investors, also sometimes called corporates, are basically the early stage investment arm of large corporations. So traditionally, corporations spurred technological change through their own internal research and development teams, what we'd call R&D. However, there's been increasing awareness and understanding that the startup industry and ecosystem is a powerful force for technological progress and change. So corporations are creating separate divisions to act like venture capital firms and to invest and provide resources into the startup ecosystem and attempt to participate and have a finger on the pulse of these systems. Sometimes you see this in the form of co-working spaces sponsored by these institutions. In New York, maybe we see spaces run by Verizon, Barclays, and Samsung. These corporate investors also typically invest in their corporation's area of expertise. And the hope is that you can leverage their existing status in the industry to your advantage. So that might be testing your product against, a segment of their existing user base, or the opportunity to partner and work with trusted vendors or development partners. Lastly, we have family offices. Family offices is a little bit more private, and they're increasingly gaining exposure to what we would call the venture capital asset class. So they're becoming a more important player in this market, but it's one that's usually less understood by startups. And so let's dive into what exactly is a family office. Family office is a wealth management company that's focused on serving a single high net worth individual or family. These family offices usually have an internal accountant, a couple financial analysts, maybe an internal attorney, and they sort of act like a hybrid of all of these other groups. They're similar to an angel because they can have a very streamlined decision-making process. They're similar to venture capital because they can write large checks. And they're similar to corporates because usually there's the family's private company that is backing or that has generated the wealth to create this family office. So you can usually leverage their industry contacts. Again, family offices don't usually have the same marketing arms or large public profiles of a VC firm or strategic investor. So they can be more difficult to pin down or find, or even to verify that they're real. And so sometimes it requires, deep relationships and, other homework to find out who they are and to verify who you're talking to. Okay, so that sums up our discussion of, common sources of capital, and we can now move into structuring. Okay, so structuring an investment. Generally speaking, early stage startups are going to use one of four structures to raise money to fund their operations. If you are raising under $1 million, you're most likely going to use one of the note, the safe, or the KISS. Just from a legal administrative cost of negotiation, the equity is going to be prohibitive if you're under $1 million. It's not always the case, but it's usually the case. And just a quick point touching back to what we said earlier about personal debt. Each of these instruments you see here, the most common forms of early stage financing, don't usually require you making any sort of personal guarantee. So when investors put their money up through these instruments, they're accepting that if the business goes under, they've lost their investment and they won't come after you personally. Okay, so the convertible note. The convertible note was, for a long time, by far the most common form of instrument for early stage fundraising. It usually requires an interest rate of 5 to 8%. You typically don't pay this in cash. It just gets added onto the principal. It does have a maturity date, so eventually it does come due. You could also, typically you might see an escrow concept. So with any of these early stage fundraisings and the first money you take in, you have to understand whether you're going to immediately start taking money in, or you're going to have investors, raise some minimum amount from your investment group before you start taking in money. And all of these instruments operate on the principle that they're going to convert at some next stage financing. And so that's one of the key pieces to understand about these instruments, is that you're going to take in money now, but what an investor actually earns on these instruments will be determined by what happens in your next stage fundraising. And so those next stage fundraisings and how these instruments convert depend on usually two principles: a discount and a valuation cap. So a discount is basically anywhere from, again, as you can see, 10 to 20%. So it's a discount on the price of your next equity financing. And the valuation cap basically sets a hard cap on the valuation of your business in the conversion. So if your business explodes overnight in value, and now all of a sudden it's $100 million, your original investors might have locked in that they get to convert their equity at some lower valuation. And again, these discounts and the valuation caps are rewards for being the earliest stage investors in your business. And so actually understanding how these discounts and valuation caps play out can be quite complex mathematical calculations, which usually require discussions with the right advisors. And so we won't dive in more about how these actually, we have a question. We'll attach questions later. Okay, so the convertible note for a long time was industry standard, but the convertible note still had a fair amount of complexity to understanding. So Y Combinator developed the simple agreement for future equity. And the idea was that this was a much more streamlined version of the convertible note. And so this is really popular in California. It's gaining popularity now in other startup ecosystems like New York, Boston, DC, Philadelphia, LA, and it's becoming more accepted by a wide range of investors. Quick point we'd like to identify is that the Y Combinator in the fall of 2018 updated their safe and switched from a pre-money safe to a post-money safe, which basically changes how those like next stage valuations are calculated. And so You should just point out and understand whether you're using the old safe or the new safe and make appropriate adjustments to your valuation numbers based on which form you're using. The next instrument that you'll see that's pretty common in the market is the Keep It Simple security from 500 startups. Probably not as common as the note or safe, but still a pretty common instrument. And the 500 startups put out two versions of their KISS. One is a debt instrument that's meant to closely mimic a convertible note, and the other is an equity instrument, which more closely mimics a safe agreement. And one thing that the KISS here has done, again, it has discounts, it has valuation caps, but they've also hardwired in other financing terms that are important to understand. For example, they have a 2x preference on liquidation. They include major investment rights. And so while these are always negotiable, it's important to understand that in a negotiation, people are going to be comparing back against original forms. So if you decide to move off of these terms in the KISS, these set terms in the KISS, you're going to have to explain to your investor, your counterparty, why you're moving off of these pre-existing terms. So again, so it's not impossible to move off of them. You'll just have to have explanations for why you're doing it. And lastly, we touched on this again, but you can always, instead of using one of these early stage instruments, the note, safe, or the KISS, you can actually just sell preferred stock or common stock. Again, here you have to set a hard valuation on the actual price of your equity, and that can make transaction costs very high. Also, usually because investors will gain certain control rights over your business when they negotiate these documents. And so you'll know if you're in this sort of realm because you'll see references to the NVCA forms or the SeriesC.com forms. And again, it's important to talk with a investment, some sort of advisor, whether it's legal or accounting, when you get to this stage of your business to make sure you're negotiating these documents properly. And next, we'll move on to our next form and get into the specifics of negotiating with a VC.
All right, so negotiating with VCs. Thanks, Zach. Let's run through, the final topic here. We'll break it down into 2 slides, 5 points each. We'll start with some overarching principles when approaching negotiations. So the first is leverage. Negotiations are often all about leverage, right? And so the goal is to find ways to tip the scale in your favor. And, the best way to do that sort of follows a lot of the guidance that we've been giving throughout this webinar about understanding the venture landscape, understanding how the fundraising process works, understanding what makes investors tick. And so the more understanding you have, the more you can position yourself for a successful negotiation. Second point is trust. So it's helpful to keep in mind that you're negotiating what is intended to be a very long-term relationship. So the time frame on getting to an exit event for a startup is typically 7 to 10 years or even more. And so negotiating a fundraising round is only a part of that relationship, but it's often the start of the relationship. And so you want to make sure that the foundation for that relationship is built on trust. And of course, it's a negotiation, so both sides need to protect themselves. But we'd say that as you go throughout the process, be honest, be respectful, use it as an opportunity to establish trust. Next point here is FOMO, or fear of missing out. There's been a lot of talk over the years in the venture industry about FOMO, and we continue to see it play out on a regular basis. And we've included a couple comments here on the slide. First is that the best way to get a term sheet from a VC is to get other term sheets. And this kind of gets at the idea of setting an auction process. So if you can generate interest from multiple investors and you have multiple options, you'll often have a better time negotiating a good deal. Second point here is that FOMO can cause a snowball effect. And this kind of gets at the herd mentality of venture investing and how momentum can really facilitate a fundraising process. And there are a few ways to do that, but we often see it centered around landing a lead investor that can really kick the funding round into gear and get other investors over the line. Next point is time is money, right? So the fundraising process often takes many months of full-time or close to full-time focus, which can obviously distract from running a day-to-day business, especially in the early days of a startup when you have a small team and the founders are wearing many hats. So it's wise to try to run an efficient process as much as you can. Some of this actually comes down to identifying signals from investors. So VCs notoriously have a hard time saying a flat out no to a founder. And this stems from a little bit of what Zach said, right? VCs, they're trying to de-risk investments, but they also don't want to miss out on what might turn into a great opportunity. So if you at least check off a few of the boxes on the VC's list of investment criteria, they often want to keep the door open to see how things progress. But it's easy as a founder to think that the continued interest means that the investor is going to invest when that might not actually be the case. So, it's okay as a founder to be upfront and ask very early in the pitch process if the investor is interested in potentially investing, and if so, what are the specific next steps to getting a check from them. Final point on this slide relates to stage, investor, and founder dynamics. So it's important to keep in mind that the negotiation process differs across stages, across investors, across founders. So for example, with stage dynamics, if you're in the early stage, you're raising from angel investors, you as the founder typically propose the structure of the deal and the deal terms. But if you're in the later stage raising from VCs, they're typically the ones that propose the structure of the deal terms. With investor dynamics, as we've discussed, angels have different motivations and processes than VCs. So you need to understand that. And then lastly here on founder dynamics, it is often a little bit harder for first-time founders to raise venture capital than repeat founders who've had a previous successful exit. And that's somewhat understandable, right? It's VCs need to justify their investments to their LPs, and it's easier sell when they can say they invested in a founder who just sold $1 billion business. Doesn't mean you don't have a shot as a first-time founder. You just might have to get over some extra hurdles. So understanding the different dynamics here can, really help with maximizing the negotiation process. And so next slide, final slide of the day, run through 5 key considerations when negotiating with investors. First point we'll make is around diligence. So as you approach a funding round, really got to make sure that you have your house in order so that you can avoid delays in the funding process. So investors typically conduct some sort of due diligence investigation in connection with their investment. And that level of diligence will vary depending on the investor. So for example, angels tend to do less diligence than VCs. But the diligence generally covers business, legal, financial matters. And we've seen many deals get delayed due to a messy diligence process. And really the last thing you want as a founder after going through a long and tough fundraising process and sort of finally getting that investor over the line is to then have the actual funding get delayed for many months because of a messy diligence process. Next point, VC math. So this kind of gets back to the theme throughout the presentation about understanding key characteristics about investors. And so for VCs, in order to get the types of returns that they're looking for on their investment, they really need to hit home runs, not singles. And interestingly, the way many VCs look at the performance of their portfolio is that about a third of their investments will meet expectations. About a third of them will come nowhere near expectations at all. And then about another third will fall somewhere in the middle of that. So short of expectations, but not a total flop. And then out of the entire portfolio, maybe only about 1/10 will vastly outperform expectations and largely make up for the rest of the portfolio. And so this generally means that VCs want to place bets on startups that they think have a real chance at being $1 billion business. And so that should guide you as a founder on how you present the big opportunity with your startup. and why it will be a home run. Next, talk a little bit about valuation and control. So the backbone of most venture deals centers around two key concepts, and that's valuation and control. So valuation gets at equity or the ownership interest in the company. As you raise money and issue equity to investors, you are diluting your ownership in your own company. So you have to be mindful about the valuation at which you are raising funds. And you don't want to be in a situation 7 years down the road, having devoted your life to building a big business to a successful exit, only to find yourself left with a very small ownership stake that actually doesn't get you the types of returns that you were looking for with the business. So that's valuation side. Control side really gets at management of the business. So VCs tend to seek some level of control over the business, whether that's through board seats or approval rights over certain actions that the company can take. And so this could result in a situation where, as the founder, you've effectively lost control over how you operate the business. And so, I think with these 2 points, you just need to be mindful about how you strike the right balance between valuation and control. And this leads to the next point about deal breakers. So we generally advise that in the early stage, just really focus on the most important terms of a deal. Try to keep it simple. As Zach mentioned, there is some standardization around venture deals. And so stick to market standards as much as possible. And if you're going to move outside of those market standards, then have a good justification for doing so. And I guess another point I'd make here is that it's okay to actually negotiate some deal terms with investors. Sometimes founders get nervous that if they try to negotiate anything, then the investor is just going to walk away from the deal. That's generally not the case. Certainly you have to strike a balance between not negotiating at all and negotiating too much, because both extremes can send negative signals. So if you don't negotiate at all, it might send the signal that you don't know what you're doing, and frankly, that you don't have the guts to stand up for things that are important to you, right? But at the same time, if you negotiate every single immaterial deal point, it might again send the signal that you don't know what you're doing and that you're very difficult to deal with. So really try to strike the balance there. And the last point we'll make here is guidance. So, get good guidance from good advisors who can steer you in the right direction. As a founder of a high growth startup, there's just a lot of stuff to figure out. And if you try to figure it out all on your own from scratch, you're likely going to make a lot of mistakes. And we've all been there, right? So if you can surround yourself with good advisors, so business, legal, financial, you just might be able to avoid some of the common pitfalls in navigating the funding process and negotiating with investors. And so we'll leave it there. We hope you found this presentation to be helpful. We're happy to open it up for some questions now, or just feel free to reach out to us later. We've included our contact information on this last slide. And thank you all for taking the time to join us today.
Nick and Zach, thank you so much. You actually do have some questions. Let's see what is happening. Do you have